Friday. It is the first Friday in January 2026, and I'm here with Jose Torres, senior economist, to dive deep into today's non-farm payroll report. How you doing, Jose?
Great to see you, Andrew. Happy New Year's, our first live stream of 2026. We thank you all for your support in 2025 and looking forward to another bull market in 2026, an extension. This will be the fourth year. Hopefully today's payrolls data can support that. Right now, the pre-market futures are up slightly. So we'll see what happens.
All right. So, Jose, let's dig in. Today is the first glance at the entirety of 2025, right? We're going to get the December payroll report, and we're going to be able to say, okay, over the course of the year, this is how the labor market changed. We're going to see like totals for numbers across different sectors: manufacturing, professional and services, and healthcare and education, and all those great things. What are you expecting, and how does that compare to the consensus?
I'm a little hotter than expectations. I think that the cyclically oriented areas of the economy are going to support a number of 100,000 this morning. There's consensuses around 60,000 to 70,000, depending on the source. Also, an expectation that the unemployment rate is going to tick down to 4.5% as per the consensus. But I think that labor supply issues are actually going to keep the rate of joblessness at 4.6. So expecting unemployment to be flat at 4.6 with a strong headline number of 100,000. Of course, 100,000 based in when you compare that number to the last 3 to 4 years, when we've had numbers of 200,000, 250,000, 300,000, really illustrates that the labor market is shifting into a lower gear from a lot of different factors like AI adoption, immigration restrictiveness, as well as the rate-sensitive areas that haven't felt comfortable hiring much. But this year, it looks like there's going to be much more payroll expansions from small business, manufacturing, construction, etc.
Well, let's take a little look back. 2 days ago, the private payroll processor ADP announced job growth of just 40,000. Is that right?
Yes. Slightly below expectations, but close to the consensus. And the market did pretty well against that backdrop. They received those numbers positively. Interest rates came down a little bit. Stocks did well. And I think that's the similar kind of number that Wall Street is looking for today, something that's near expectations, something too hot that could push rates higher. The 10-year has been looking to break 420 to the upside, and a move to 425 would be the highest since early September. Of course, today, another thing that can affect treasuries is the expected Supreme Court opinion or decision on whether the president had the legal authority to implement broad-based tariffs. If they do block those duties from the beginning of fiscal year 25 through December, the U.S. government has collected approximately $315 billion. That has helped to alleviate, to cushion the fiscal imbalances that we've been running in the U.S. since the end of President Clinton's administration back in 2000, 2001. If the Supreme Court decides to block those tariffs, and that is, our participants do expect that, only a 23% chance that this court will sustain those trade policies. So I'd expect rates to go higher, but stocks would also do well because corporate earnings would catch a short-term tailwind from margin expansion, lower input costs, smoother trade routes. But I think I'd prefer for the Supreme Court to maintain the tariffs because I think it's good for a fairer trade balance. Yesterday we got the trade numbers, Andrew, the narrowest trade deficit since 2009. That's due to partially due to some of the volatility and the front loading that occurred, particularly with pharmaceuticals. But nonetheless, it's pretty significant, a 17-year low in the trade deficit, the narrowest, meaning that the balance between what the U.S. imports and exports is becoming more even. Of course, that's been a goal of the Trump administration. A lot of onshoring ambitions, which of course would be affected by today's Supreme Court decision in either direction. So, on one side, folks, that opponents of the trade policy, the protectionist measures, would say that that positive number was due to the volatility and the front loading. And of course, the supporters of the onshoring ambitions would point to progress on the manufacturing front.
So just to explain to the audience, Jose, when you said the front loading, are you talking about the import side of the ledger or the export side of the ledger?
The imports. So on October 1st, you had certain pharmaceutical levies begin to get implemented. So prior to October 1st, a lot of firms, they ordered a lot more pharmaceuticals than they would normally order. So that would boost the numbers in September and August, and then suppress the import numbers in October. And that certainly was a factor as to why that trade balance number was so low. Really shattered expectations. Expectations were in the 50s, and we came in the 20s, so around $29 billion trade deficit.
And again, if you just want to explain to the audience, you talked about a 23% chance, a reduction in the perceived chance that the Supreme Court will uphold Trump's tariff policy. That's according to the ForecastTrader, is that right?
Yes, and we're going to pull that up so you guys can see.
And don't forget, to the audience, you can ask any questions of the team here on X and LinkedIn. We've got a question come in here about the super commodity cycle. Let's see. Andrea's helping us here in the background, so I just need to look at that question. The commodity super cycle, maybe this is one for after the numbers. Oh no, I don't know. Is a big drop coming? I guess that's in the price of commodities. What are your thoughts on that, Jose?
I think copper can continue going to the upside because you have heavy AI needs for copper, and you have a lot of geopolitical stockpiling going on. So a lot of nations are essentially maintaining their copper supplies much more than they would otherwise maintain, due to fears that the AI race becomes increasingly competitive, and then some of those sovereigns don't have enough copper to compete. So copper, I think copper can continue going to the upside. It's been over the last year, we had this big drop back in August, but from back in late July rather, but from that point on, it made a new high here this year at around 613 or so. So copper, I think, could keep going higher. Gold and silver, they've had significant rallies. That's been the story there, of course, has been store of value bids, central banks sustaining accommodative policies, while inflation has generally been above target in an aggregate basis. Of course, some nations have been at target, i.e., for example, Canada's right there, the ECB, the EU, right there, right around 2%. So some nations have been able to get their inflation numbers back to target. Here in the US, folks, we'll be talking about the CPI next week. Of course, today is BLS Jobs Friday. In real-time, measures of inflation are very positive right now, looking like the CPI is going to be back at 2.5%, 2.4% in the next few readings. So that's also very positive for the rate cut path. But let's get back to commodities and the actual question. Gold, significant rally.
Sorry to interrupt you, but I'm wondering if the question is coming from the angle of what's happening with oil prices, or the potential for oil prices on the back of what's kicked off in Venezuela over the weekend. So
yeah. So if we're going to talk specifically about oil, I was going to get to that. I was going down the entire list, and it happened that crude oil is at the last on my graph here, but it probably should be at the top because it is the most important. Thank you, Andrew. So folks, crude oil, what happened in Caracas is essentially removes a lot of the probability of an oil price spike. And that's always something that fixed income investors are paying attention to and pricing in, because if you have an oil price spike, then that immediately drives inflation higher because it's such a critical input. So we saw what happened when Russia invaded Ukraine back in 2022, and the CPI went up to 9% or so. That's because oil went up to 130. So now with the US controlling Venezuelan supplies, there's essentially a lessening risk that that case could occur, especially against a backdrop. Forget about Venezuela for a second. Before that happened, we were already looking at a significant supply outlook. A lot of the nations in OPEC plus, less developed nations, they need cash right here, right now. So, they don't want to drop production too much, even though prices are low, because they need currency. So already we're looking at a heavy supply outlook. And then when you see what happened in Venezuela, and now the US controlling Venezuelan oil supplies, folks, when the Chavez revolution started roughly 20 or 25 years ago, the US oil majors had investments in Venezuela, namely ExxonMobil, Chevron, ConocoPhillips, and the government essentially took away those assets from the US private sector and essentially made it property of the Venezuelan Marxist revolution. So, this is sort of karma, you could call it, of the resources shifting back into the US's hands. And that's really good from a geopolitical perspective for the US. Of course, President Trump has been trying to get Putin to play ball in Europe and try to get to a peace accord with Ukraine. And I think this is the US's way of saying, hey, if you're not going to give us some wiggle room, if you're not going to help us a little bit with peace in Ukraine, then, we're going to take Venezuela. Of course, the drug trafficking, that's a separate issue as well. But I think crude oil here essentially has a ceiling around $65 or so, which is very positive, because prior to that, the ceiling was closer to 80 or 90.
Yeah, I've seen predictions for about $50. I'm not sure where that's come from, but that obviously has implications for inflation and gas prices down the road. We've got two and a half minutes left until the jobs report. What other labor market data have you been following, Jose? The Challenger layoffs report, the initial claims, and so on. What's the kind of the other alternative views of the labor market?
Yeah, claims have been very well maintained in the safe zone. They've remained in an area that is not worrisome. Continuing claims are going sideways. Initial claims are going sideways. Challenger Christmas and Gray data yesterday was very positive. You saw December job cuts fall to the lowest in 3 years, and you saw hiring intentions rise to the highest in 17 months. So that was particularly supportive for the cyclical areas of the market. The Russell 2000 reached a fresh all-time high yesterday. The Dow and the S&P reached some fresh highs the last few days. And the Russell is looking to, if it opens where it's at in the pre-market, it will mark a new all-time high.
Yeah, Jose, give us a quick rundown on the markets ahead of the data.
Yes. So the markets are doing well. Yields are higher too, though. The S&P is up 25 bips. The Qs are up 27. The Russell's up 38. And we're going to get the numbers in around 40 seconds. So we'll see what the results are. Expectations are 60,000, 64,000 coming from the private sector. Last month's overall was 64. On the private side, 69. So we'll be getting the numbers in soon, folks, in around 20 seconds.
And as you said, the forecast trader was looking for. Was that more? Where's the at the money line in terms of the today's headline number?
Yeah, we're right around close to the Wall Street consensus. There were some probabilities on the tails, expecting a number way higher or way lower as well. But right around 60,000. We'll see the numbers should be out now.
Okay. 50,000?
Yes, 50,000, 4.4%. So big pull down in the unemployment rate. Rates are going higher, folks, due to the unemployment rate going down. That's a critical number for the Federal Reserve. Equities are maintaining their gains. And let's look at the composition of the job gains.
Says employment continued to trend up in food services and drinking places, healthcare and social assistance. Retail trade lost jobs, surprisingly, in December.
Yes, 25,000 jobs losses. Jobs lost. Excuse me. Yeah, pretty weak, very weak report when you look at it under the hood. Leisure and hospitality was a gainer of 47,000. You know, that is a cyclical area, but not of the highest quality jobs. Government added 13, of course. Education and health services added 41, but that's non-cyclical. So the cyclical area is not. This is not the broad-based strength that we saw in the ADP report, folks. On Wednesday, we saw most sectors add jobs. We saw construction add jobs. In both surveys, however, the manufacturing sector lost jobs, as did professional business services. So, this is not a good report, folks.
I'm seeing both manufacturing and mining and logging both declining as well.
Yes.
Kind of a hot topic for the administration there.
Yeah, no, manufacturing, Andrew, has been a weak point in 2025. We've lost jobs in that sector. Of course, that hasn't been, President Trump has wanted, part of his election campaign was that he was going to bring a lot of those jobs back. However, it's only the first year of the administration. 2026, we're expecting to see the tailwinds of the signature taxation package passed in 2025. So that includes a 100% depreciation first year on capital expenditures. And that's expected to bolster activities in factories and bring back jobs, bring some investments, et cetera. So we'll see what happens in 2026. But 2025 has definitely been bad for manufacturing. ISM manufacturing survey also consistent with that. Now the S&P global data PMIs, those have been stronger than ISM, but it looks like that's just an anomaly.
Interesting points as you look at that histogram there, Jose. I mean, first of all, again, construction is negative, but half the amount on the retail trade size there. Is it because it's December? Then, and on the other side of the ledger, the concentration in private education, leisure and hospitality. Is that something the Fed takes into consideration, that 40,000 jobs is 40,000 jobs? It's weak. But if it's concentrated in just two sectors, what is the impediment to cutting interest rates? And then the third thing would be the government sector there, still adding jobs. Is that in response to the government reopening?
Let's look at, so for your third question, let's look at the more detailed data to see whether the government was bolstered by the federal government or by the municipals.
Mm-hmm.
But let's answer, while I pull that up, let's answer the first two questions. So we're talking, the second one, I believe, Andrew, remind me, was about interest rates and what this...
Yeah, so how does like a narrow concentration in those two typical sectors, leisure and I forget the other one now, but if the Fed is looking at a net gain, but it's concentrated in just a couple of sectors, it's not broad-based, does that give them more latitude to cut interest rates?
Not when you have the unemployment rate going down. And that's the unfortunate situation. If you had a flat unemployment rate, or if you had the unemployment rate going higher, then absolutely that would definitely lead to higher odds of an interest rate cut. Now let's look at what's going on with the Fed funds curve.
How are yields responding this morning to the report?
Yields are responding negatively. They're going to the upside. Right now, no cut in January is expected, folks. No cut in March. No cut in April either. But the market is pretty sure that we'll get a cut in June. So that's where we are right now. I mean, April, I shouldn't say that. I mean, April, it's close to a coin flip for a cut. So April's close to a coin flip, but still favoring a hold. It's in June where the probabilities are pretty elevated that we'll get a cut. 77%.
The report is broadly pushing out expectations of a rate cut.
Yes.
Yeah.
Yes.
So then,
especially when you look at the sorry to interrupt you, especially when you look at what's leading the yield curve north. So right now you're actually seeing the shorter tenors. So this is a bear flattening jump on the Treasury curve, where the shorter, the monetary policy sensitive tenors, the 2-year, is rising faster than the 10-year. So higher yield curve, but flatter, not steeper. So really that's the response from the Treasury market of a report that is going to push back Fed rate cut expectations, but not really that strong from an inflationary perspective or an economic growth perspective to really do much to the long end of the curve. Let's talk a little bit about wages too. Wages came in pretty strong, 0.3% month over month, 3.8% year over year. The annualized number was expected to be 3.6, both marking an acceleration from the prior month. Month over month was 0.2% in November. Year over year was only 3.5. So, that's a little bit of some wage gains, which when you see those wage gains start to accelerate and inflation is going down, that's a good justification to want to be bullish on the American consumer. And for that K-shaped economy that we've been talking about for the last 12 to 24 months, for that to start to narrow and for the lower income cohorts and the middle income cohorts to start to have more momentum and more confidence out there, because the real wage gains are expanding, they're widening, and compensation is running ahead of inflation.
Let me throw something into the mix here, Jose. I mean, so the labor market's half of the Fed's dual mandate. The other side of it is inflation. I saw the comments from Stephen Myron. I think he was on a Bloomberg interview the other day, and he blamed 150 basis points of inflation, the current inflation rate, on the way the index is calculated. Therefore, he basically said that he's still expecting deep interest rate cuts this year. What are your thoughts on that?
I'm not supporting that case wholeheartedly, but I will say that it's an argument worth paying attention to, because the shelter component, there is a sense that housing prices are really cratering, both the rents and the values. Just that price discovery hasn't been allowed yet because transactions have been limited. So in his case, you have the immigration restrictiveness, which is essentially plunging household formation and leading to reduced demand for homes, as well as reduced pricing power for rents, because you just don't have as many people. So he's arguing that shelter is way lower, and maybe the CPI should really be, it's already at the target, or it's at 1.9 or 1.8%. Generally speaking, that's the argument. And for that reason, we should be cutting significantly. I think we should be cutting, but I'm still afraid. I have more of a hawkish bias, so I'm still afraid of inflation upside risks. But I think 75 basis points this year in 2026, I think that would be the appropriate policy to get us back in the high twos, assuming that, and I am hoping and forecasting that inflation is going to be to the low twos by April. So I think a Fed rate at 275 on the lowest side of the range, that'd be 75 basis points of cuts. That's a good place to be with inflation at 2%, or at 2.3 even, or at 2.2. Andrew, I think we're behind on a few questions. Let's please our audience, folks. We want to please you guys, and we want to be here answering your questions. So let's get to the questions.
Jen on LinkedIn says, is a rate cut really in the best interest of the market?
Absolutely. Absolutely. You need rate cuts for the broadening in the equity space. If in an environment where we're seeing waning artificial intelligence enthusiasm, excuse me, you need the Dow Jones, you need the Russell 2000, you need a lot of the areas in the market that are non-tech, for example, that are more cyclical, like energy, like materials, retail, consumer discretionary, industrials, real estate, financials. You need those areas to start bolstering the benchmarks. And those areas can benefit directly and strongly from interest rate cuts. In fact, the Russell 2000 has a narrow path to victory, but it looks like we are going to be able to wiggle in that little space to the upside, because it essentially requires reaccelerating economic growth. I'm expecting 3.4% this year, alongside a rate cut. So look for the Russell 2000 to potentially have a year north of 20% after failing to participate really, since 2021.
A good question from Pedro here on LinkedIn. And I'll just have to preface this by saying we can't give advice. That's not what we do here at Interactive Brokers. He notes that geopolitics is playing a fundamental role in the economy. In your opinion, what stocks or ETFs would allow investors to maintain their value in such complex scenarios? And I would also have to preface that any response there that things are changing very, very quickly, Jose.
Yeah, so I guess the question is which areas of the market could remain stable despite a volatile geopolitical situation? Is that really the question?
Yeah.
Yeah, I think the defensive areas, the healthcare, utilities, consumer staples, those tend to be more value-oriented dividend payers. I think those areas would be able to do fine under volatile geopolitical conditions. Of course, defense is also something that can sustain its value or increase its value against that backdrop, as well as energy. Despite oil prices going down, energy can still perform relatively well, especially amongst the large majors, because they have low break-even prices, especially if Venezuelan, if a lot of those assets formally come onto their balance sheet, that would raise those share values via a greater book value, via more capital, more assets on the balance sheet.
Do the oil companies make more money as oil prices decline?
They don't, but if they have more wells, standing alone, they don't. But if their assets just expanded by 20% or 25% or 15% or so, then you can still offset that lower oil price with more supply. So that's the answer there. And then also those low oil prices will also disincentivize a lot of the smaller producers from producing oil. So that's also a decent reason to want to own large cap energy in that environment.
All right. I'm going to go to the most recent question first. You talked about local versus federal hiring on the government side, Jose, but we didn't actually get the split. Are you able to get that one back?
Yes. You want to go to Steve real quick?
Yes, let's do that.
Hi, I'm Steve Sosnick, Chief Strategist at Interactive Brokers. Where do you think inflation is going? Do you see a recession ahead or more growth on the horizon? What's your prediction for the Fed funds rate? Right now, 73% of traders expect it below 4% in December. What's your forecast? Interactive Brokers forecast contracts let you turn insights into action. Buy yes or no contract on ForecastTrader and earn $1 for each correct prediction. We invite you to explore the data, spot the trends, and make your call. Start forecasting today at ibkr.com/forecast. The best informed investors choose Interactive Brokers.
We're back, folks.
And I think we've got, as you're thinking about the government, the split in job growth. There's a good question here about from Carla. He makes a comment. But remember, in May, the leadership composition at the Federal Reserve changes, and of course, the U.S. administration wants lower rates from there, and therefore will influence them. On that note, we're getting close to a nomination to being announced, and you're able to take a view on that in Forecast Trader. What are those? What's the composition of likelihood of the different competing members look like, Jose?
Yeah, so Warsh is actually in the lead now at 39%. Kevin Warsh, former Fed governor, current National Economic Council director, his odds were as high as 90% or so in early December, and now we're down to 35. So still pretty neck and neck between both the two Kevins, Kevin Warsh and Kevin Hassett. Current Fed governor Christopher Waller is at 14%. Judy Shelton's at 2%, and Michelle Bowman is at 2% as well.
It's very, very interesting odds if you like the Forecast Trader. I think I know what I'd do there. All right, so
would you go both Kevins, or would you go all three of these? Because
to be honest, I think I would lean more towards Kevin Warsh.
Okay.
And honestly, I think it's just really a question of leadership at the Fed. I'm not sure that Kevin Hassett is the right person to do it. It's kind of regardless of odds. Even if Kevin Hassett was in the lead, I'd probably put my money where with what makes most sense for the Federal Reserve.
Yeah, and then going back to government, so the federal government added 2,000, state lost 7, and local added 18. So really, local government education 15.6 thousand. That's what drove the 13,000 gain in government. Just to answer the previous question.
Excellent. Okay, the 2s10 spread. What's it at? How does it compare to historic levels? I think you got a chart for that, haven't you? The 2s10s.
Yeah, absolutely. It's going to take me about 30 seconds to pull that up. So in the meantime, maybe we'll go to another question if we have it.
We have one more question here. Give me 1 second to pull it back up. Gonzalo on LinkedIn says, I believe that the years following 2020, Geopolitics has had an extremely strong influence on the fear and greed index. I'm assuming we're talking the VIX index from SIBO.
Fear and greed, CNN he's talking about, but the VIX is one of the inputs there.
Sorry, what's the fear and greed?
It's the CNN fear and greed index I think he's talking about.
Okay, so let's continue the question. This is very evident in cryptocurrencies and commodity trading. It's an imminent influence stemming from human actions when interacting with information, even if this news is sometimes exaggerated or understated. So I guess more volatility within the fear and greed index based on human emotions. Any thoughts on that? Or he says it's very evident in cryptocurrencies. Cryptocurrencies have been very interesting recently.
Yeah, they've been volatile. They've totally disconnected from the correlation in the NASDAQ, I would say, because the NASDAQ, hasn't been performing too strongly, but it has maintained its gains more or less. And Bitcoin has really just, been performing relatively poorly. Let's pull up a chart here.
That correlation's really dropped away. Various explanations for that, but the Nasdaq was the leading, had a better year than the S&P 500, Jose.
Yeah, absolutely. The Nasdaq. It has been really outperforming for in the down years, though it tends to pull back a lot harder than the S&P. Like in 2022, the Nasdaq got hit a lot harder than the S&P. Because it has a lot of growth stocks in it. Bitcoin, I think retail enthusiasm about it. I think that some worries amongst the younger cohorts of investors has led to some liquidity pressures, and also just I think the $100,000 mark is really important for Bitcoin. in terms of valuing its actual use in society. We know that crypto and the blockchain technology is very valuable, but the question is how much each token should be worth, and the associated products around it. So I think that's a frequent debate. The 100,000 mark has really proven to be a psychological level of resistance. Of course, we broke way past it to 126, but then we pulled back quite aggressively.
A lot of short investors with short positions got liquidated, according to a report I read on CoinGlass the other day. A real high number involving many millions of dollars. I was very surprised to see that. So I wasn't really aware that you could go short cryptocurrencies.
Yeah, I mean, I'm pretty sure. I mean, you could short the ETF, for example.
No,
I know they had.
this is underlying coin.
Yeah, underlying coin. Yeah, let's go to the tens and twos spread here. Much steeper curve. Around 70 basis points of steepening.
So just in context, that's moved from zero, what, about a year ago, I'm guessing? And let's have a look at your chart.
Yeah, it was -1%. You had a pretty deep inversion. And historically, folks, the inversions precede recessions. As you can see, the gray bars, indicate recession. So when you see this blue line go below the zero, you have a recession afterwards. Of course, we have not seen a recession after this inversion. I mean, even the 2019 inversion, right? For those that believe in a higher power or anything like that, even the 2019 August inversion preceded a recession that was really not related to any financial market imbalances. Really, it was a health pandemic, right? So I mean, so that's something that folks always scratch their head about. These perhaps non-clear signals that the yield curve sends, and when it inverts, folks start getting worried. Can it predict recession, or can it predict even a pandemic? So this time, though, we've been running higher. Markets in the economy have been supported by a plethora of factors. Fiscal support has been strong, monetary accommodation, company balance sheets have been terrific. So no real appetite to get rid of labor in a significant way. And those have all really supported the economy and the markets.
Here, Jose, is that this inversion, the more positive yield curve, is happening at a time when the market is still banging on the door looking for additional interest rate cuts. It's almost a kind of a careful what you wish for perspective here. It tells me, this steepening of the yield curve tells me that you might not get any more cuts. If the economy was to strengthen, would we still see that?
I think the curve is too steep. I think that the duration should be cheaper, but right now there's uncertainty around the Supreme Court decision and the potential for all that revenue to be sent back as refunds. So for that reason, I think that there's still a premium being issued on duration, and that's why we're so steep. But I don't think with inflation in the low twos soon, I don't think the tens belong anywhere above 4. I think 390 would be fair value right now, also in the 30 years. So I think we're going for a flatter curve here, folks. I don't think we go any steeper.
That's really important, the way you put that. It's just that right now, like after a report like today, the market's not feeling the love, is it? It's as we said, it's pushed out expectations a little bit. Jose, what can you in terms of forecast trader and event contracts, what tenures can you take a position in? Can you trade that 2-10 spread?
Yeah, you can trade it. You can trade it.
And we've got another excellent question coming on LinkedIn. We'll get to that in a minute as you're going through this.
Yeah, let's get to that question while I look for this.
Okay, let me just bring that out. So Anthony says, it seems like the real policy of the Trump administration is to weaken the US dollar and inflate our way out of our deficits. Debt to GDP is unsustainable. Isn't that what gold is telling us? It tends to be the real indicator. I'm interested in your comments on that.
I think that the weaker dollar policy, I think that's more to bolster the manufacturing state of the nation and to support factory activity. I don't think inflating the way out of the debt is actually, I don't think that's what they're doing. I think they're actually trying to balance things with the tariff revenue, and the deficit has been compressing. So I think that that's why I'm a supporter of the Supreme Court maintaining Trump tariffs rather than blocking them, because it's been really good for the fiscal situation. We can grow out of if we can grow out of the debt and simultaneously bring in more revenue via tariffs, that can significantly bring down our debt to GDP ratio and bring us back really to a sustainable path. I know that's something that isn't widely believed, but I really think that we have a chance for that to occur when you combine really robust economic growth with tariff revenues. Tariff revenues can rise to 400 billion, 500 billion. That could really offset a lot of the nation's expenses. So I'm historically a budget hawk, and I'm feeling good about the compressing budget deficit. Hopefully it can sustain itself. Hopefully we don't go into an economic downturn, because as we know, when we have recessions, especially recently, you have a lot of liquidity, and then fiscal balance really goes out the window, and monetary balance does too. And who cares about inflation targets? So I don't want to go there. So I'm pretty positive about where we are right now. I think we're ready for the program, unless we have one or two more, just because I have a long list of things to do. I have reporters calling me. And there's only so many hours in the day.
Let's just wrap up with the forecast contracts here. What's your favorite contract currently?
My favorite contract is going to be the House of Representatives. I think the Democrats are going to win the House, a majority control of the House, just because in the midterms, after you have a party switch, so you had the President Biden of the Democratic Party, we had to shift to President Trump of the Republicans. Usually after a shift like that, you tend to go the other way in the midterms. So 74 cents here is, I think it's a value. I'd be sitting in at 70 cents with a lot of size to try to get hit at 70. But I think that this should be closer to 85. Now, the President Trump is trying to bolster his popularity. Pandemic style household $2,000 checks have been talking about ways to lower mortgage rates through $200 billion in bond purchases. So there are efforts being made, but I think that inflation and right now, well, not inflation, the rate of inflation, but the cumulative effects of inflation over time have really weighed on the population. And also the immigration situation is, I think is hurting the Republican odds right now. Latin American men were a huge cohort of folks that helped President Trump get elected. So that segment of the population has been starting to turn on the president in terms of approval. And I think that's going to deliver the Democrats with a win in the House this November.
Excellent. Brilliant session, Jose. We'll look forward to speaking to you next week over the CPI data release. Some great questions flowing in there from the audience on LinkedIn and X. Thank you to you, the audience. And join us again. Is it this time next week, or are we doing it Thursday next week?
We're doing it. Andrea, can you help us out real quick? When is the CPI out? We're doing it at the same time, the day of the CPI. That is Tuesday. The 13th on Tuesday, folks. We'll be back on Tuesday at 8:15 to talk about the CPI. Thank you, Andrea. Andrea's in the background, always helping us, waking us up, setting us up with the audio and the microphones and the cameras and all that. So we appreciate our support team. Andrew, thank you very much. Ladies and gentlemen, thank you very much. We'll see you next week. And we also have the Spanish one occurring for the Fed decision near the end of the month. Folks, take care. That's the 28th, January 28th. Thank you all. Andrew, thank you so much for joining us. And we'll see you next time.
Thanks, Jose. Bye for now.